As of Tuesday, April 11, WTI crude had surpassed $81 per barrel just a few days after OPEC Plus declared an additional reduction of 1.16 million daily barrels in production. Moving ahead by a month, WTI crude is now nearly $10 cheaper. Despite OPEC's promised supply cut, Kurdistan's production suspension, and China's demand growth, oil prices have declined, and they could continue to do so, at least for a while. The primary cause of the recent 4-week drop in oil prices has been the economic outlook, particularly in the United States. Federal analysts are struggling to find alternative phrases for recession, and media outlets are increasingly using the term. This economic uncertainty has contributed to the decline in oil prices. Numerous factors are causing concern, including a substantial decrease in diesel demand. This drop comes after months of anxiety that the U.S. is experiencing a diesel shortage due to demand outstripping supply. However, that is no longer a concern. The significant decrease in diesel demand suggests more significant problems, which some analysts describe as a slowdown, correction, or even a recession. Meanwhile, inflation is decreasing, but it is still considerably higher than the Federal Reserve's desired level, reaching 5% in April. This development prompted another rate hike, which did not benefit those optimistic about the oil market. This is due to the historically inverse correlation between interest rates and oil demand. Interest rate hikes strengthen the dollar, which results in higher oil costs in absolute terms, impacting demand negatively. At the same time, the manufacturing sector has been shrinking for 6 consecutive months. It shrank yet again in April, although S&P Global estimated an expansion in the sector for the last month. It begins to become clear why it is so hard to call a recession in the U.S. for now. The latest oil price trends suggest a recession, regardless of what the official data states. The positive aspect is that this recession appears to be primarily in the minds of oil traders, as opposed to reflecting the overall state of the U.S. economy. Although manufacturing is shrinking, the service sector is expanding, indicating that not everything is lost. However, there remains a risk of another significant bank failure that could have a negative impact. The banking sector tremors of recent weeks have also had a lot to do with oil prices. Fears of a banking meltdown have rippled into fears of a broader meltdown, and that has translated into a fear of oil demand destruction and, consequently, a sell-off. But here's the thing. The supply situation may be about to change. In March, China's oil demand reached a record-breaking 15 million barrels per day. U.S. crude oil inventories have fallen below the 5-year average for this time of year, marking an extended period of weekly declines. Moreover, according to Reuters and historical trends, U.S. oil and gas production growth is anticipated to decrease significantly over the coming months. Analysts noted the several months lag between price movements and drilling activity in the U.S., which means that it takes several months for drilling to expand in any noticeable way after a sustained rally in prices. It takes several months between a sustained price decline and the consequent decline in drilling activity. Recent official data indicates that U.S. production had already decreased in February. While still almost 1.2 million barrels per day higher than the February 2022 average, it was also over 80,000 barrels per day lower than the January 2023 average. This is not a significant amount considering the total daily production of 12.5 million barrels, but it is a notable deviation from the EIA's February projection of a record high output increase. Overall, if the EIA's projections are accurate, oil prices may continue to decrease, particularly if fuel demand remains low as the driving season begins. However, if the EIA's projections are incorrect, oil prices may rise again unless there is another significant recession concern. The sell-off was far greater than what market balances are showing, namely lower inventories, with the prospect of inventory draws as the Northern Hemisphere's summer unfolds. Oil prices are currently not aligned with oil fundamentals, and a correction may be imminent. As evidenced by the recent month-long decline in oil prices, expectations about oil fundamentals are just as significant, if not more significant, than the fundamentals themselves. A further decline in oil prices may occur if there is another significant bank failure, which could have a ripple effect.